So here we are at part 2 of our 3-part video series about the Fed. We talked in the first video about what the Fed is, when it was formed, and now in this video I want to get more into what the Fed does and what the Fed has done historically, and most recently what the Fed did in the early 2000s during the financial crisis that really began in 2008. What the Fed did and how that lowered interest rates, not necessarily the Fed lowering the federal funds rate, but purchasing of mortgage-backed securities and purchasing of 10-year treasuries is definitely what led to super hyper low mortgage interest rates, which increased liquidity in the economy by opening up credit, essentially. So let's talk about that. Okay, so monetary policy is set by the Fed, and that is essentially the setting of the federal funds rate, the rate at which banks loan each other money, and then the banks mark that money up when they loan it to you. So that's kind of how the Fed manages the economy, at least in a broad sense. Now, Congress sets fiscal policy for the country, the president, Congress, voters, theoretically. So let's talk for a minute about some of the things the Fed has done throughout history to help stabilize the economy, to stave off the types of panics that were occurring from our early history into the early 1900s. Okay, so looking at what the Fed has done historically, they bailed out some railroads in the 1920s. They did some support of bank liquidity in the 1930s. Fast forward to the 1970s, bailing out another railroad, although that was more of a Treasury bailout apparently. In the 1980s, Fed-backed rescue of banks due to bad loans. Sound familiar? In 1990, the savings and loan crisis was again more of a taxpayer bailout, but the Fed was involved there. And then a long-term capital management issue that the Fed coordinated in 1998. And then most recently, the bailout of 2008. Now, the bailout of 2008 and then subsequent quantitative easing by the Fed, kind of two different things. Let's take a look at what the U.S. Treasury did in 2008 versus what the Fed did. Okay, so looking at what the U.S. Treasury did in 2008 was something called TARP, the Troubled Asset Relief Program. Now, TARP was undertaken by the U.S. Treasury and primarily funded by taxpayers. There were hundreds of billions of dollars injected into financial institutions and insurance companies like AIG that were all collapsing in 2008 due to essentially, again, bad investments, reckless investments. And then the U.S. taxpayers through the Treasury stepped in with about $700 billion and plugged that hole, essentially. Now, most of that money, we're told, has been paid back. The net cost to taxpayers on TARP was supposedly $32 billion. So of the $700 billion spent, it only cost us $32 billion. So don't get too excited about that. Now, this is looking at TARP here on the U.S. Treasury website. It talks about what it is, its history, key facts, what did it do, etc. So you can check this out on the Treasury website. Now, while the Treasury was involved in essentially buying the troubled assets themselves, the bad loans, horrible investments, patching the holes in that system to keep all those financial institutions from utter collapse, the Fed began a program called quantitative easing. Quantitative easing was the Fed purchasing 10-year treasuries and mortgage-backed securities. When there are a lot of 10-year treasuries being purchased, the demand for those treasuries goes down, hence the yield goes down. And when the 10-year Treasury yield goes down, mortgage interest rates go down. Okay, like I said, when the 10-year Treasury yield goes down, so do mortgage interest rates, and vice versa. When the 10-year Treasury yield goes up, mortgage interest rates go up. I can illustrate that with these two graphs right here. We recently talked about this in a market update, and that's actually where the idea for the video series started, because we got into a discussion about this and people started asking more questions, so I wanted to kind of fill in the blanks here. So this is the Freddie Mac Primary Mortgage Market Survey, and right now I have it, I'm looking at the 1980s right now. And so if we look over here at, for instance, June of 1981, on this Treasury yield chart that I pulled up on CNBC, you can pull up a Treasury yield chart on any website that you can find one. I found one on CNBC. In June of 81, 15.82% was the Treasury yield. Now let's look at October, July. Here we are in June of 1981. So the Treasury yield was at 15.3 something, mortgage interest rates at 16.71. And then as you can see here, as the Treasury yield went down over time, so did mortgage interest rates. Finally, down to a low in 1987 at 9.05. And if you look over here at 1987, the Treasury yield was about 8.8. So it definitely kind of jives. And then when we look at just 1 year here, you can see that the Treasury yield chart definitely parallels essentially mortgage interest rates. So the relationship between the two is undeniable. And when the Fed buys massive amounts of treasuries, and when I say massive amounts, I mean billions and billions of dollars. Quantitative easing number 1 started in 2008, around the same time as TARP, and went for a period of time, and then there was a QE2 and 3, and then during COVID they did it again. All of this to the tune of well over $1 trillion when all is said and done. And so what does that do to the economy? We'll talk a little bit about that in the next video. But for now, you just understand that the Fed is involved in setting the federal funds rate, U.S. monetary policy, and then also when things happen, they step in and stabilize. What effect does that have? We'll talk about that in the next video. So thanks for watching. I hope it was informative. Again, if you find factual errors on my part, feel free to point them out. Differences of opinion, I guess you can point those out too. However, this is a complicated subject and I'm attempting to do it at a very sort of high-level overview without getting too far into the weeds, and it's tough not to. But that's what we've got for now. So stay tuned for video number 3 when we talk about the potential effects on the economy from all of this bailout and bond buying stuff that the Fed does. See you soon.